Let's get back to the discussion on mid-cap IT, because after Mindtree's decent set of numbers, Mastek has posted a good set of Q4 earnings as well. Growth was led by the UK segment, and the company's order book has expanded by over 15% and is now at a record level. To discuss the earnings fine print, we're joined by Hiral Chandrana, the global CEO at Mastek, who's with us right now. Hiral, thanks a lot for joining us. It's been a great year for you. I mean, FY22, you've ended with a revenue growth of over 26%. How is the terrain looking right now, and what is the average growth that you could eke out in FY23?
Thanks, Sonia, for having me. Good morning. Like you mentioned, we are pleased with the results. Both Q4 as well as full year results have been very strong. 26.8% revenue growth year on year, as well as our profit after tax also grew about 32.4%. So overall, pleased with the financials. Quarter on quarter, 5.3% constant currency. We're again on a good trajectory. In terms of customer demand and market, while there are uncertainties, macro level uncertainties, we've seen a really good uptick in demand. Like you pointed out, strong order book backlog at 193 million. It sets a good foundation for us to grow on in the FY23 fiscal year, which we are already in right now. And some continued momentum on large deals and growing our existing accounts where we have a strong presence.
Hiral, hi, good morning. The big talking point for IT companies has been the pressure on the margins. For you, it's not as visible. You've still managed to eke out 21%. But do you see some kind of pressure going forward, or do you think you'll be able to sustain the margin here?
Anuj, as you know, we've been communicating strong execution focus is what's getting demonstrated in the margins. However, we do want to invest back in the business, and there are certain capability areas, there are certain markets that we want to grow exponentially, like Americas. And we'll continue to make the right investments in both capabilities as well as our go-to-market. To look at the demand that we're seeing right now, we'll need a lot more firepower and engine to even ramp up to the customer demand. So we believe that some investments are needed. Margins will continue to be under pressure because of the talent and the cost and the inflation that is impacting the entire industry. But we have some fixed costs leverage, and we believe that we, in the 20% range is where we feel comfortable. That's what we've communicated in the past, even though we don't guide margins. But our strong execution is really getting demonstrated there.
Attrition rates, they are holding at around the 28% odd mark. Where is that headed, Hiral? If you could give us a broad sense on that.
Yeah, so Nigel, good point. The attrition at a quarterly level actually did stabilize for us. As you would have seen, some of our competition actually increased their attrition worsened. But in our case, we're at 5.7% at a Q4 level. So while it is at a LTM last 12 months at 28%, but we are seeing a trend, a trajectory of some stabilization. I don't want to get satisfied at this point right now because, it is a continuous process. Our HR and people teams have done a fantastic job. Our business teams are working very closely with our employees. But we did see some stabilization in Q4 compared to our Q3 attrition.
So we were speaking to an analyst who tracks the sector very closely, and he said that at worst, this attrition problem could be about a 3 to 4 month issue, and perhaps by October, November, things could settle. Is that your assessment as well?
Sonia, it's difficult to predict, as you know, but there is definitely signs of some stabilization. Now, having said that, there's a lot of demand from various sectors, right? It's not just about IT services companies. It's about startups. It's about captive centers. It's about multinationals. It's about new companies that are investing in technology. So the same skills that companies like us go after are being catered to by many other organizations. Having said that, we're doing something very different as part of our Vision 2025 strategy and our FY23 big bets. One of the key areas that we've called out is differentiated talent. Our scope of cloud and digital engineering is very focused. So we are razor sharp on looking at how we can upskill that talent, both internally as well as get from the market. Our talent attraction and recruiting ability has improved over the last 6 months. We're getting onboarding a lot more freshers, interns, as well as laterals. And, as far as retention strategies are concerned, we do see some level of stabilization, but I don't think we need to see about 2-3 quarters of consistent stabilization, if you ask me, right, for us to stay calm on that.
But that's actually a good problem to have overall for the industry, right? If attrition is at a high purely because the tech space is brimming with opportunities, it just goes to show that it's a transient problem, perhaps. I wanted to also ask you about your plans to acquire any companies, because I think you hinted at that recently. Anything that you've closed in on?
So we are very aggressively looking. In fact, we did a realignment of our leadership structure recently, which has been yielding some positive results. Americas, we wanted to double down in, and so we've made a change in that leadership. We've actually created a new role, as part of our strategy and transformation growth office. And that role is actually going to look at capability building, M&A, as well as partnerships. As well as we've integrated our Oracle business much more closely as part of our global delivery structure, and UK and Europe go to market as well. So in that context, we're spending significant time on looking at assets. As we've communicated in the past, cloud platforms, data cloud, as well as CX and automation areas are where we focused on. Good progress in the last 3-4 months, and definitely in the next couple of months, we're looking at zeroing in on something substantial. But it's a long process, as you know, and we're very cautious about making sure that we're investing in the right asset. But the automation space, the confluence of the automation space along with customer engagement and data is a very interesting space for us, and we're seeing that demand in our market. So that's really where we're focused on right now.
Hiral, unlike the traditional IT companies which are US centric, you are largely a UK and Europe facing company, and of course you are trying to get into US as well in terms of increasing your revenues there. But if you could tell us what's happening in various geographies, and there was some pressure, I guess, in West Asia as well, if you could address that as well.
Sure, Anuj. So UK continues to perform very well. We actually pleased to inform we've closed another couple of large deals in our UK government space, in our home office, where we do work in the asylum services as well as in the customs and borders immigration space. Very positive momentum on the digital engineering as well as DevOps, and how we are doing managed services out there to protect the borders. As far as US is concerned, we have taken a very focused approach of about 30 accounts, where across manufacturing, retail, consumer, and healthcare life sciences, we've called out healthcare and life sciences in the past as a very, very big bet for North America. So we're doubling down on that with leadership as well as account focus. Okay. And we're also starting to see a lot more traction in enterprise accounts, larger deals, larger enterprise accounts in the US. Middle East, we're actually taking a focused approach, but otherwise US and UK are doing really well.
Okay, final question before we let you go. You've given us qualitative aspects, but if you could put a number to it. Broad revenue growth for this year, that's FY23, and also the net employee addition in the past year was around 1,200 approximately. What could be that number, in the coming year?
So we do not guide, Nigel, as you know, in terms of specific numbers, but we are very confident about industry-leading growth, and looking at continuously investing in the business to maintain that growth and even maybe up it. We believe our recruiting engine is now geared up to add 500 people, 400 to 500 people every quarter. So we definitely would see a lot more headcount addition in FY23 compared to FY21. Having said that, it's not just about adding people. We are focused on value-based delivery. We are focused on business outcomes-specific delivery, which is also a differentiator for us. So that combination with the people addition and the growth momentum makes us feel comfortable for FY23.
Okay, Hiral, we'll leave it there today. Thanks a lot for joining us. It's always good talking to you, and we hope to have more conversations with you. All the best for the future. Let's move on then and address the market. The pre-open has settled in line with what the SGX